Hi everybody, welcome to the first in our series of video lectures for Chapter 12, Statement of Cash Flows. The Statement of Cash Flows must be included with any set of financial statements prepared in accordance with the generally accepted accounting principles. The Statement of Cash Flows reports cash receipts or inflows of cash and cash payments or outflows of cash during a financial accounting period. Cash flows are separated into three categories: operating, investing, and financing activities. The detailed disclosures of sources and uses of cash make this financial statement particularly useful to users. Information in this financial statement helps answer such questions as these. What explains the change in the cash balance? Where does the company spend its cash? How does the company receive its cash? Why do income and cash flows differ? The Statement of Cash Flows helps users decide if a company has cash enough to pay its debts. It helps users evaluate the company's ability to pursue unexpected opportunities. It helps managers plan day-to-day operations. And it helps managers make long-term investment decisions. Cash flows include both cash and cash equivalents. The Statement of Cash Flows explains the difference between the beginning and ending balances of cash and cash equivalents. We continue to use the phrase cash flows and the statement of cash flows, but remember that both phrases refer to cash and cash equivalents. So what is a cash equivalent? Cash equivalents are short-term, highly liquid investments that are readily convertible into cash and sufficiently close to their maturity date that the market value is unaffected by interest rate changes. Since cash and cash equivalents are combined, the Statement of Cash Flows does not report transactions between cash and cash equivalents, such as cash paid to purchase cash equivalents and cash received from selling cash equivalents. However, all other cash receipts and cash payments are classified and reported on the Statement of Cash Flows in one of three categories: operating, investing, or financing activities. Individual cash receipts and payments for each of these three categories are labeled to identify their originating transaction or events. A net cash inflow occurs when receipts in a category exceed the payments from a category. Net cash outflow, or use of cash, occurs when payments in a category exceed receipts. On page 454 of your textbook, you will find three exhibits: Exhibit 12.1, 12.2, and 12.3. I'll let you study those pages. Don't overlook them, they are important. So page 454 of your textbook, Exhibit 12.1, Exhibit 12.2, and Exhibit 12.3 all talk about cash inflows into a category on the cash flow statement and cash outflows from the category on a cash flow statement. But I find that the Exhibit 12.4 is more useful. Exhibit 12.4 on page 455 of your textbook is something we're going to use a lot. So I'm going to ask you to flag that page so you can flip back and forth to that page. It's a very important page as we get into practicing the preparation of a statement of cash flows. The three sections of the cash flow statement are shown in the blue boxes: operating cash flows, investing cash flows, and financing cash flows. This slide or this exhibit will help you determine what sources and uses of cash flow into each section in the statement of cash flows. For instance, in the operating cash flows section, changes in current assets and current liabilities shown on the balance sheet will flow into the operating section on the cash flow statement. Changes in long-term assets, such as plant assets, equipment, vehicles, etc. If those changes arose because of a receipt or payment of cash, those changes are shown in the investing section of the statement of cash flows. Changes in long-term liabilities, such as long-term debt or bonds payable, and changes in equity, such as common stock and dividends. If those changes arose because of a receipt or payment of cash, they are shown in the financing section of the cash flow statement. Notice that in the prior slide, I emphasized that changes in long-term assets, long-term liabilities, and equity that arose because of a receipt or payment of cash are shown in the statement of cash flows. Some investing and financing activities do not affect cash flows. One example of such a transaction is the purchase of long-term assets by using long-term note payable. This transaction involves both investing and financing activities, but does not impact the current period cash. Such transactions are reported at the bottom of the statement of cash flows or in the footnotes to the statement because of their importance and because the full disclosure principle requires the disclosure. Examples of transactions commonly disclosed as non-cash investing and financing activities include the following: retirement of debt by issuing equity stock, conversion of preferred stock to common stock, lease of assets in a capital lease transaction, purchase of long-term assets by issuing a note or a bond, exchange of non-cash assets for other non-cash assets, and purchase of non-cash assets by issuing equity or debt. Don't get too concerned about these because most of these topics are beyond the scope of this basic accounting class. Well, that's all for this video. In our next video, we'll continue our discussion on the statement of cash flows.